Assalamualaikum to Sir MOKTAR bin Haji Awang, our lecturer for AUD589. We are members of Group 1 AC2204A. For the assessment, we pick sales and collection cycle as our topic. My group consists NURIN JAZLINA binti ARIFF, me FARAH binti FAUZI, ALIAH AISYAH binti KAMARUZAMAN, and ADLINA binti YUSOF. In sales and collection cycle, there are 5 transactions. First is sales, second, cash receipts, third, sales return and allowances, fourth, write-off uncollectible account, and lastly, bad debt expense. For this presentation, we only cover 2 transactions, which is sales and cash receipts.
Before we go further, firstly, we need to know what is the sales and collection cycle. Sales and collection cycle in a business refers to the set of processes that begin when a customer purchases goods or services and ends when your business receives payment in full. The objective of sales and collection cycle is to evaluate whether the account balances are affected by the cycle and fairly presented in accordance with accounting standards. There are 5 classes of transactions under this cycle, which are sales, cash receipts, sales return and allowance, write-off of uncollectible accounts, and bad debts expenses. So, let's take a look at the sales transaction first. Under sales transaction, the accounts involved are sales and account receivable. There are 4 business functions under this transaction, which are processing customers' orders, granting credit, shipping goods, billing customers, and recording sales. The documents and records involved are customer order, customer order or sales order, shipping document, sales invoice, sales transaction file, sales journal or listing, account receivable master file, accounts receivable trial balance, and monthly statement. The next transaction is cash receipts. Under this transaction, the relevant accounts are cash in bank and accounts receivable. It is to process and record sales receipts. There are 4 documents and records under this transaction, such as remittance advice, pre-listing of cash receipts transaction file, and cash receipts journal of listing. The third transaction is sales return and allowance, which involving the accounts of sales return and allowance and accounts receivable. The business function is processing and recording sales return and allowance. Under this class of transaction, there are 2 documents involved, which are credit memo and sales return and allowance journal. Next, write-off of uncollectible accounts. The accounts involved are accounts receivable and allowance for uncollectible accounts. It is to write off uncollectible accounts receivable and it involves the uncollectible account authorization form and general documents. The last transaction is bad debt expense. Its relevant account are bad debt expense and allowance for uncollectible accounts. The business function is providing for bad debts. There are only 1 document involved under this transaction, which is general journal. To get a better understanding of documents and record involved in a business, you can refer to textbook on page 418 until 421. Firstly, we're going to explain on the sales transaction. The first accession under sales transaction is occurrence. Sales is where all recorded sales are for shipments actually made to non-fictitious customers. The audit objective is to check whether all recorded sales are for shipments actually made to non-fictitious customers. The relevant accounts involved are sales and accounts receivable. It is to record for the sales of goods and rendering services for cash and credits. There are a few key of internal control in the occurrence objective. The first control procedure is credit is approved automatically by computer by comparison to authorized credit limits. Second, sales are supported by necessary documents such as authorized shipping documents and approved customer's order. Next, batch totals of quantities shipped are compared with the quantities billed. And lastly, the statements are sent to customers each month. For the audit procedure, the auditor may perform 2 tests, which are test of control or substantive tests. Under test of control, auditor may examine customer order for evidence of credit approval. Moreover, examine sales invoice for supporting bill of lading and customer order. Next, examine file of batch totals for initials of data control club. Finally, observe whether monthly statements are sent or not. While for the substantive test, auditor may account for a sequence of sale invoices. Next, review sales journal and master file for unusual transactions and amounts. And lastly, trace sales journal entries to supporting documents, including duplicate sales invoice, bill of lading, sales order, and customer order. If sales transactions are supported by necessary documents as evidence, for example, for test of control, the documents are customer order, bill of lading, sales order, sales invoice, monthly statement, and sales transaction file. While for substantive tests, the documents involved as evidence are sales invoice, bill of lading, sales order, customer order, sales journal or listing, account receivable master file, and account receivable trial balance. For this objective, the auditor is concerned with the possibility of three types of misstatement. Firstly, sales are included in the journals for which no statement was made. Next, sales recorded more than once, and also shipments made to non-existing customers and recorded as sales. The first two types of misstatement can be due to an error or fraud, while the last type is always a fraud. All of the three misstatements will lead to an overstatement of assets and income.
Move on to the next section, completeness. Completeness means when all existing sales and transactions are recorded completely and in respective accounts. The other objective of completeness in sales transactions is to check whether all existing sales transactions are recorded. On the other hand, there are four relevant accounts, which are accounts receivable, sales, cash discounts taken, and sales return and allowances. However, in order to make sure all sales completely recorded, the internal control of company need to make sure that the shipping documents are pre-numbered and accounted for weekly, and the batch totals or quantity shipped are compared with quantities billed. Following that, the company must carry out two audit procedures to ensure that all sales transactions are properly recorded. The first one is test of control. The company need to check the accounts for a sequence of shipping documents and examine the file of batch totals for initials of data control cloud. The second one is substantive test. The company need to trace selected shipping documents to the sales journal to be sure that each one is included. Next, for the audit evidence of the test of control are sales journal or listing and shipping documents. Meanwhile, for the substantive test is shipping document. The possible misstatements that the company might do are overstatement or understatement of sales and accounts receivable, overstatement or understatement of sales return and allowances and accounts receivable, and misstatements in account receivable and related income statements accounts.
Now, let's move on to the third section in sales, which is accuracy. The accuracy is sales are recorded at the accurate amount. The audit objective is to check whether all the recorded sales for the amount of goods shipped are accurately billed and recorded. There are 5 relevant accounts, which are sales, account receivables, cash discount taken, sales return and allowances, and bad debt expenses. The internal control for accuracy are sales are supported by authorized shipping documents and approved customer orders. Batch totals of quantities shipped are compared with quantities billed. Unit selling prices are obtained from the price list master file of approved, and statements are sent to customers each month. Next, it is the audit procedure. It is divided into two, which are the test of control and the substantive test. There are few tests of control, which are examine sales invoices for supporting documents, examine file of batch totals for initials of data control code, examine the approved price list for accuracy and proper authorization, and the last one, observe whether monthly statements are sent. For the substantive test, are trace entries in sales journals to sales invoices, recompute prices and expenses on sales invoices, and the last one is trace details on sales invoice to shipping documents, sales order, and customer order. The audit evidence for the test of control are sales invoice, price list, and customer statement, while for the substantive tests are sales journal, sales invoice, shipping documents, and customers' orders. The last one is possible misstatement for accuracy, which are sales and account receivables, overstatement or understatement. Uncollectible account receivables have not been provided for, and understatement or overstatement of sales returns and allowances.
Move on to the next section, posting and summarizations. Posting and summarization means when sales transactions are correctly included in the accounts receivable master file and are correctly summarized. The audit objective of posting and summarization in sales transaction is to check whether all sales transactions are correctly included in the accounts receivable master file and are correctly summarized. On the other hand, there are two relevant accounts, which are account receivable and sales accounts. However, in order to make sure all sales completely recorded, the internal control of company need to make sure that computer automatically posts transactions to the accounts receivable master file and general ledger. Account receivable master file is reconciled to the general ledger on a monthly basis, and statements are sent to customer each month. Following that, the company must carry out two audit procedures to ensure that all sales transactions are properly recorded. The first one is test of control. The company need to examine evidence that accounts receivable master file is reconciled to the general ledger and observe whether monthly statements are sent. The second one is substantive test. The company need to trace selected sales invoices from the sales journal to the accounts receivable master file and test for amount, date, and invoice number. Use audit software to foot and cross-foot the sales journal and trace totals to the general ledger. Next, for the audit evidence of the test of control are account receivable master file, general journal, and monthly statements. Meanwhile, for the substantive test are account receivable master file, general journal, sales journal or listing, and sales invoices. The possible misstatements that the company might do are overstatement or understatement of sales and accounts receivable, overstatements or understatement of sales return and allowances and accounts receivable, and misstatements in accounts receivable and related income statements accounts.
Next is classification of sales transaction. Classification means sales transactions are correctly classified. The audit objective for classification in sales transaction is to check whether all sales transactions are correctly classified. There are 5 relevant accounts, which is sales account, sales return and allowance, cash discount taken, bad debt, and account receivable. The internal control for classification of sales transaction is account classification are internally verified. In order for a company to properly record that, there are two audit procedures. The first one is test of control, is to examine document package for internal verification. Second one is substantive test, examine duplicate sales invoice for proper account classification. The audit evidence for classification are sales transaction file and sales invoice. For the possible misstatement, for overstatement and or understatement of sales and account, overstatement or understatement of sales return and allowance account receivable, misstatement in account receivable and related income statements account.
The last assertion in the sales is timing. The meaning of timing is sales are recorded on the correct dates. The audit objective to check whether all sales are recorded on the correct dates. There are 5 relevant accounts, which are sales, account receivables, cash discount taken, sales return and allowances, also bad debt expenses. The internal control for timing is shipping documents are pre-numbered and accounted for weekly by the accountant. The audit procedure for timing is divided into 2, which are test of control and substantive test. Test of control is account for a sequence of shipping documents. The substantive test is compare the date of recording of sale in sales journal with duplicate sales invoice and bill of lading. Next, the audit evidence for the test of control is shipping documents, while for the substantive test are sales transaction and delivery notes. The possible misstatement are sales are recorded at the wrong date and the sales transactions date is not matched with delivery notes.
Next, we're going to explain on the cash receipt transaction. The first assertion under cash receipt is occurrence. Cash receipt is where all recorded cash receipts are for funds actually received by the company. The audit objective is to check whether all recorded cash receipts are for funds actually received by the company. The relevant accounts involved are cash in bank, which is debit from cash receipts, and account receivable. This is to record for the receipt of cash for the customers for the goods received or service rendered. There are two keys of internal control in the occurrence objective. The control procedures are accountant independently reconciles the bank account, and batch totals of cash receipts are compared with computer summary reports. For the audit procedure, the auditor may perform two tests, which are tests of control or substantive tests. Under test of control, auditor may observe whether the accountant reconciles with the bank account, examine files of batch totals for initials of data control clerk. While for the substantive test, the auditor may review cash receipt journal and master file for unusual transactions and amount. Next, auditor may trace cash receipts entries for the cash receipt journal entries to the bank statement for testing for dates and amounts of deposits. And lastly, prepare a proof of cash receipts. As for the audit evidence for test of control, the documents needed are customer order, bank reconciliation, and master file. While for the substantive test, the documents involved as evidence are cash receipt journals or listing, account receivable master file, and cash receipt transaction file. For this objective, the auditor is concerned with the possible misstatements that can occur, which are recording fictitious cash receipts, failure to record receipt from cash sales, failure to record cash receipt from collection of accounts receivable, cash receipts that have not been deposited, early or late recognition of cash receipt, and lapping of accounts receivable.
Move on to the next section in cash receipts, completeness. Completeness means cash receipt is recorded in the cash receipt journal. The audit objective of completeness in cash receipts is to check whether all cash receipt is recorded in the cash receipt journal. On the other hand, there are 5 relevant accounts, which are receipts of interest, dividend, bank book, cash sales, and account receivable ledger. However, in order to make sure all cash receipts are recorded, the internal control of company need to make sure that pre-listing of cash receipt is prepared, checks are restrictively endorsed, batch total or cash receipts are compared with computer summary reports, and statements are sent to customers each month. Following that, the company must carry out 2 audit procedures to ensure that all cash receipts are properly recorded. The first one is test of control. The company need to observe pre-listing of cash receipts, observe endorsement of incoming checks, examine file of batch totals for initials of data control clerk, and observe whether monthly statements are sent. The second one is substantive test. The company need to obtain pre-listing of cash receipts and trace amount to the cash receipt journal, testing for names, amounts, and dates, and compare the pre-listing with the duplicate deposit slip. Next, for the audit evidence of the test of control is pre-listing of cash receipts. Meanwhile, for the substantive test are pre-listing of cash receipts and cash receipts journal or listing. The possible misstatements that the company might do are recording fictitious cash receipts, failure to record receipt from cash sales, failure to record cash from collection of account receivable, and early or late recognition of cash receipt.
Now, I'm going to explain the third assertion in cash receipts, which is accuracy. It occurs when cash receipts are deposited and recorded at the amounts received. The audit objective is to check whether all cash receipts have been deposited and recorded at the amount received. There are 2 relevant accounts, which are bank accounts and account receivables. The internal control for accuracy are bank accounts are reconciled by accounting independently. Batch totals of cash receipts are compared with computer summary reports. And the last one, statements are sent to customers each month. Next, it is the audit procedure. It is divided into two, which are the test of control and the substantive test. For the test of control, I observe whether the accountant reconciles bank account, examine file of batch totals for initials of data control clerk, and the last one, observe whether monthly statements are sent. For the substantive test, I obtain pre-listing of cash receipts and trace amounts to the cash receipts journal, testing for names, amounts, and dates, and the last one, prepare proof of cash receipts. The audit evidence for the test of control are purchase order, receiving report, and customer's invoice, while for the substantive test is cash receipt journal. The possible misstatement are the amount received from cash receipts are recorded either overstated or understated, and the last one, misstatement of the amount in cash receipts in the transaction.
Next is posting and summarization of cash receipt. Cash receipts are correctly included in the account receivable master file and correctly summarized. Audit objectives for posting and summarization of cash receipt is to check whether all sales transactions are correctly included in the account receivable master file and are correctly summarized. And for the relevant account are bank account and account receivable. The internal controls are computer automatically post transaction to the account receivable master file and general ledger. Account receivable master file is reconciled to the general ledger on a monthly basis. Statements are sent to the customer each month. There are two audit procedures. The first one is test of control. Examine evidence that account receivable master file is reconciled to the general ledger. Observe whether monthly statements are sent. Second one is substantive test. Trace selected entries from the cash receipt journal to the account receivable master file and test for amount and dates. Use audit software to feed and cross-feed the sales journal and trace totals to the general ledger. For audit evidence is cash receipt journal or listing. Next, for possible misstatement, recording fictitious cash receipt, failure to record receipt from cash sales, failure to record cash from collection of accounts receivable, early or late recognition of cash receipt. Move on to classification of cash receipt. Cash receipt transactions are correctly classified. The audit objective is to check whether all cash receipt transactions are correctly classified. There are four relevant accounts, which are receipt of customer, dividend, rents, and investment by owner. For internal control is cash receipt transactions are intern. There are two audit procedures. The first one is test control. Examine document package for internal verification. Secondly is substantive test. Examine pre-listing for proper account classification. The audit evidence are cash receipt transaction file and pre-listing of cash receipt. For possible misstatement are recording fictitious cash receipt, failure to record receipt from cash sales, failure to record cash from collection of account receivable, early or late recognition of cash receipt.
The last assertion in the cash receipts is timing. The meaning of timing is cash receipts are recorded on the correct dates. The audit objective is to check whether all cash receipts are recorded on the correct dates. There are five relevant accounts, which are collection on accounts from customers, receipt of interest, dividends, rents, and cash sales. The internal control for timing is procedures require recording of cash on daily basis. Next, the audit procedure for timing. Test of control is observe unrecorded cash at a point in time. The substantive task is compare the date of deposit per bank statement to the dates in the cash receipt journal and pre-listing of cash receipts. The audit evidence for the test of control are purchase order, receiving report, customer's invoice, reconciliation of bank statement, cash receipts journal, and pre-listing of cash flow, while for the substantive tests are cash receipts journal and pre-listing of cash flow.
Lastly, the possible misstatement for timing is cash receipts are recorded in the wrong time. That's all from us for topic sales and collection cycle. Thank you so much.